Financial Accounting, Chapter 10, Liabilities, Current Liabilities, Installment Notes, and Contingencies. So we've been doing the traditional march down the balance sheet, and we have gone through all assets, so it's time for us to go into the liabilities section. So in this first part, we'll talk about common types of liabilities and move into payroll tax liabilities. After that, we'll talk about some accounting for employee fringe benefits and installment notes, and then we'll do a little quick overview of contingent liabilities and how they're reported on the balance sheet. So let's talk about a current liability. We've talked about this before, so it's fortunate that a lot of what we do is review from chapter to chapter to try to accumulate this knowledge. So when a company or a bank advances credit, it's making a loan. So if you go to the bank and take a loan out, remember that loan is a liability to you, but on the bank's accounting records, it's a receivable for them, an asset. So the bank advances credit, making a loan to the company. We're now looking from the company that's borrowing the money. The company or bank is called a creditor or lender. The individual receiving the loan is called a borrower. It's the person that's borrowed the money, or a debtor. So we have creditors and debtors, and yes, that's sometimes the way students can get confused with debits and credits. But the creditor is the lender. That's where they talk about establishing good credit. And the borrower is the debtor, the person that owes the debt. Debt is a liability by the debtor, and if it's long-term, it's greater than 1 year. If it is a current liability, it is less than 1 year. Accounts payable versus accrued liabilities. Very good definitions here from the text. An accounts payable is a purchase for merchandise or supplies. So if you look at Walmart, they have an account titled Accounts Payable. It's somewhere around $30 billion, and that is the debt for all of their inventory, the merchandise that they're going to sell. Other companies, or most companies, also have accrued liabilities, and these are other types of bills aside from merchandise or inventory and supplies. And these bills are things like the electric bill, insurance, property taxes, payroll taxes. We'll be looking at some of these types of accrued liabilities in this chapter and future ones. So accounts payable, sometimes called trade payables for inventory. Accrued liabilities are debts owed for other types of bills. So short-term notes payable, what happens if the company signs a formal note? It's no longer an accounts payable, it's a notes payable. Just in reverse when we talked about accounts receivable versus notes receivable. So let's take an example. Our company borrows $1,000 from the Murray Company because we have an overdue accounts payable. We say that we'll pay them back in 90 days at 12% interest. Here's the journal entry to show that on August the 1st, this accounts payable no longer exists. Notice we have debited a liability, so we have taken it away. We've decreased it. We've increased this notes payable. Notice our explanation shows the term and the interest rate. Remember that face amount times interest rate times time. When the note matures, the entry to record the $1,000 is going to include interest, as we've talked about in the past, and it's going to look like this. The company that owes the money will repay the $1,000, so they will debit notes payable to show that they've paid this off right here. They will credit cash for $1,030 because they calculated $30 in interest expense this way. 1,000 times 12% times 90 divided by 360. Again, remember, we're using 360 days in a year just to make it a little easier for calculations. An installment note is a debt that requires the borrower to make equal payments. And this is often things like a car loan or a mortgage. And every time an installment loan is paid, part of the payment that's made is to reduce the amount of the loan, and the other part is interest. So that's the hard part about borrowing money, and that is that not only do you have to repay the money that you've borrowed, but you also have to pay interest, and there will be a stated interest rate. I'm sure most everyone is familiar with credit cards and credit card debt that can range from 15 to 18% interest. And this credit card debt, you will repay principal as well as interest. So an installment note is one that generally it's monthly payments. Sometimes it could be annually. Each payment including principal and interest. Payroll refers to the amount payroll refers to the amount paid to employees for services during an accounting period. And payroll starts up a liability for the business because there's payroll taxes that have to be paid. So the payroll taxes that are withheld from an employee's paycheck are a liability to the company because they have to submit those payroll taxes to the governmental entities and other organizations. So we're going to take a pause here and get away from liabilities for just a minute, just because it's an important thing to add related to payroll taxes. So an employee is going to be subject to having payroll taxes withheld from their paycheck. So what's the difference in somebody that gets paid by the hour and doesn't have payroll taxes withheld, considered to be a subcontractor, versus an employee? So it's all about control. And I say that very clearly from a tax standpoint. An employee is an individual that is told by their employer what time to be at work or what specific jobs to do, how to do the work. They will be using the employer's tools or facilities. A subcontractor, however, is an individual that does work for many, many other organizations, not just one. So why do we bring this up in an accounting class? Because it's important for individual students for personal financial planning. So if you are an employee of a company, that's the only company generally you work for. Some people have 2 or 3 employees, but not often. And they will provide you a W-2 at year end with taxes withheld. And those taxes withheld are a payroll liability of your employer. However, if you're a subcontractor, maybe you are a landscaper or you do paint work for a contractor. If you're a subcontractor, that means you work for many different organizations. You may do painting for several general contractors in town. You may do landscaping or accounting for others. And as such, you're a subcontractor, and it's your responsibility to keep up with those payroll taxes and to submit them to the U.S. government. There's a lot of fraud involved in individuals who are claiming themselves to be subcontractors when they're employees. There's even more fraud with individuals who get paid by the hour that don't submit their payroll taxes the way that they're required to. So let's move on and talk about specifically the employee and the payroll liability that comes from this. An employee, generally in the managerial or administrative area, is going to be salaried. Individuals who do maybe manual labor, who maybe work on the factory floor, will generally receive wages, and they're paid by the hour. Generally, salaried individuals don't receive any overtime. Here's an example. John McGrath is a salesperson who makes $34 an hour, and he gets paid time and a half in excess of 40 hours a week, according to his company. If McGrath works 42 hours, then he gets regular hours plus the time and a half, and his total earnings are $1,462. That $1,462 is also considered gross pay, and there will be taxes withheld from this pay. This gross pay will have taxes withheld or deductions to arrive at net pay, which will be a smaller amount. very similar to gross accounts receivable and net accounts receivable, and gross plant, property, and equipment, and net plant, property, and equipment. Something has been subtracted. So net pay, take-home pay, has subtractions or deductions such as federal and state and local income taxes, medical insurance, pension or retirement contributions. I would add that some companies have charitable contributions withheld from their employee paychecks. Some employees have their wages garnished for child support or alimony that they owe. Some individuals have contributions withheld from their pay so that they can contribute to a savings account to help them with their savings. So this is what an employee's form that I guess you could call it certifies, certificate that provides the information that an employer needs for withholding. It's called a W-4. It's similar to a W-2. A lot of people get them mixed up. So a W-4 is required whenever a new employee signs on to work, and it tells the employer how much to withhold from their paycheck. And this kind of information will be filled out. This shows that this individual has one dependent. So it appears that this individual is single with no dependents other than himself. And this will be used by the employer to figure out how much tax to withhold. The taxes that are withheld, first of all, FICA, Federal Insurance Contributions Act, has Social Security and Medicare. Social Security is the payments that retirees receive or disabled individuals. Medicare is health insurance for senior citizens. FICA is subject to withholding by Congress, and this is not the actual amount, but this chapter assumes 6% for Social Security, 1.5% for Medicare. So just from a tax professional's standpoint, Social Security is actually 6.2%, Medicare is actually 1.45%. So assume that John McGrath has those earnings of $14.62, then he will have $87.72 withheld for Social Security and $21.93 withheld for Medicare, for a total of $109.62 for his FICA. Other deductions, as we've talked about, from gross pay could be for retirement, charitable, life insurance, health insurance, alimony or child support. Usually that's a court order. Pre-tax spending accounts to help pay for amounts that, such as deductibles for medical insurance, and there's many, many others. I know I have parking withheld from my pay. Okay, so let's look at a calculation of the employee's pay. So if John says, I will authorize, and he signs authorizations for money withheld for retirement, this is a charity, and for federal income tax, then his net pay is going to be calculated as follows. His gross pay, as we've already talked about, including time and a half, and his net pay, net is always after the deductions. It's a smaller amount, and it is these two for FICA and this one for federal income tax, retirement savings taken out here, and the charitable contribution. So his gross pay, and he's going to pay income tax on this amount, but his take-home is this amount. All of these deductions that were withheld from his pay are current liabilities of his employer and have to be recorded as a current liability. These things have to be submitted to the Social Security Administration and to the federal government. This one might go to their retirement company, whatever the name of their retirement company is. The United Fund is going to receive these funds, and so the employee has all this withheld, and the employer has the responsibility of submitting. So what about the employer's payroll taxes? Well, the employer is going to have to do some payments themselves of money that's not withheld from the employee's pay. Most individuals aren't aware of this, and that is that the employer has to match or pay exactly the same amount of FICA tax that's withheld from the employee. The employer also has to pay a temporary amount for federal unemployment tax, and there's also a state unemployment compensation tax. And these two are never paid for by the employee, but if the employee is laid off, they can go to the unemployment office and draw unemployment benefits. You can recall times in 2007, 2008, during the economic recession, when unemployment compensation was extended by the government. That's because it only lasts a certain amount of time. And again, unemployment compensation is paid for by the employer. So here we have the employee has Social Security and Medicare and federal tax withheld, among other things that they choose. And the employer, or the business, also pays an exact and equal amount to the government and Medicare, and they have to pay to the federal government unemployment tax and unemployment compensation tax to their state. Now you understand why there is so much fraud in payroll, and that is that businesses often fraudulently hire employees under the table because they want to avoid all of these payroll taxes, and as a result, they will pay under the table, meaning they will just hand them a flat cash, or they will pay them a check for nothing withheld. And I can only say as a tax professional that this is fraudulent, and if the employer gets caught, then the employees will also be caught, and they will get caught up in a worse advantage if they haven't reported any of the money that their employer paid them. And there's a very large division of the government that's related to employment fraud. So, employer payroll taxes and employee taxes withheld are current liabilities of a business, as well as accounts payable and accrued liabilities. We'll discuss a few